The Alpha Horizon. Thinking different. Acting aware.
Coming quickly on the heels of the first Alpha Horizon podcast of the year. Welcome to this second episode, for which I'm joined by our investment strategist, Simon Peters. We'd like to discuss a specific topic that is impossible for investors to ignore, namely inflation. There is a lot of noise in terms of the macroeconomic and global markets landscape at the moment. And as such, we felt it would be worth exploring what this means and what investors should be aware of. My name is Douglas Branson, and I'm Head of Business Development. Hi Simon, thanks for joining us again.
Hi Doug.
Now that 2022 has started, what do you think is the key problem, and what are the main considerations for investors at the moment?
Hi Doug, and thank you for the question. The world really is facing two investment challenges in my view. First, there's the market problem. Following a 40-year bond bull market, yields hit their lows and bond prices their highs in 2020. Since then, yields have rallied further, hurting bond markets. Suffice to say, though, there is still little to no yield in fixed income markets. However, investors are also faced with equity markets at their all-time highs right now. And then secondly, inflation is picking up with yields following. That makes for an uncomfortable place for investors, especially for those exposed to the highest quality areas of the bond market, where there is minimal to negative yield, or those investors exposed to long duration bonds.
Understood, thanks. Now, inflation has been a topic for a while, with the noise and debate around it becoming absolutely front of mind at the end of last year and the beginning of this year. So can you highlight what investors need to know to help guide their investment decisions?
Well, the US just printed a 7% year-on-year increase in inflation, but Europe is hardly lagging, with the UK at 5.4%, German inflation rising an even higher 5.7%, and the overall euro area inflation at 5%. So what do investors really need to understand to ensure their portfolios are protected? Well, a couple of points here. Inflation is already extremely high. Interest rates of minus 50 bips in the Eurozone are not consistent with 5% inflation, GDP and unemployment close to pre-COVID levels, a recovering economy and pandemic, and close to maximum fiscal and monetary support. Yes, inflation is peaking, but the question investors should be seeking an answer to is, what is the likely inflation level in the coming year? And specifically, is it likely to be much lower than 2%? Inflation impacts market yields and interest rates, which have a direct impact on bond portfolios and equity valuations. And until recently, the market believed this inflation we are seeing right now was irrelevant for markets, which is increasingly being questioned.
And following on from that, where do you think inflation goes from here? And what does that mean for investors' portfolios and asset allocation decisions?
So, is there anything we can sensibly say about inflation in the coming year? Here, I think there is a reasonable expectation that goods inflation, which is pushing up current inflation, will abate as demand rebalances towards services and supply chains respond. That is the good news. European inflation is coming down from 5%. However, companies are likely to pass on at least some of their current higher input costs to consumers, and households have seen their real wages sink. Higher energy costs are likely to galvanize their desire for higher wages in 2022 and 2023. What this means is inflation, though falling from its highs, may well be stickier and higher than the optimists, and central banks for that matter, hopeful, especially as inflation expectations are beginning to pick up. Now, the US Fed is beginning tapering, and the market now expects 4 interest rate increases this year. With the German 10-year government bond yielding 0%, yields are also likely to trend higher, with the ECB almost certainly under pressure to bring policy rates back from minus 0.5% to 0, and inflation expectations rising. Bondholders are likely to continue to see volatility and relatively sparse returns.
Great, thanks Simon. Finally, and perhaps most importantly, in what areas of the markets can investors find assets that have a good chance of beating inflation over the coming 12 to 24 months?
Where can bondholders access reasonable returns? Well, one area of the bond market that has top decile yields and half the duration of the overall bond market, thereby reducing any likely volatility, is the subordinated debt of financials. Central banks have always excluded bank bonds from their huge QE programs as they regulate the sector, and were worried that this would be a conflict of interest. But fortunately, the result is that yield has been left on the table for investors. The equity market is slightly better positioned for higher yields, though the longest duration equities are beginning to experience more volatility and poorer returns. However, the financial equity sector is one of the few sectors that benefits from higher yields. The European bank sector currently yields 6.2% and is going higher, and has 40% upside just to where it was as recently as 2018 as it recovers from the COVID-19 recession. In my view, these two areas are definitely worth considering to help protect portfolios against inflation and providing a reasonable yield.
Great, thanks Simon. So before we go, and in the interest of sharing what we have been hearing since the start of the year, it is clear that investors recognise the inherent risks of inflation, and particularly in the context of how portfolios have been positioned coming into the end of 2021 and the start of 2022. That said, there's been a reluctance to fully embrace a change to portfolio exposures given that central banks have kept their foot so firmly on the accelerator. It seems that this nervousness to adapt asset allocation to structure portfolios differently so that they are more suited to an environment characterised by higher inflation is changing. And this is based on two things. Firstly, our conversations with clients and the questions we're being asked, and secondly, the nature of the flows we are seeing. Clients have been increasingly willing to rebalance their fixed income exposure to higher yielding, shorter duration assets such as subordinated debt. We have also seen increasing interest in inflation hedges and investing in equity sectors that are positively correlated to higher yields and inflation, such as the financial sector. With that in mind, I would like to say thank you to our listeners and thank Simon for his time and thoughts once again. Please have a look at the Market Insights section of our website at www.algebris.com, where you will find Simon's written note on inflation, as well as our other commentaries and thought pieces. We look forward to picking this discussion up again soon. So, until next time.
The Alpha Horizon. Thinking different, acting aware.